Hi there. Thanks a lot for tuning in. It is Dan Kerr's DK Analytics. Today's date is 9/26/18. We're coming back to you in video format. The name of this video is Politics Juxtaposed Against Bubble Asset Valuations. I published a post last week, post 47, that I want to reference. The title of that post is "With Rising Interest Rates, If You Must Buy, Purchase Value versus Growth Stocks, and then some." The post goes into, quote, "and then some," unquote, more than it does into value and growth stocks, more than the title suggests. Specifically, I'm referring to the underpinnings of it all, while calling out, if you must be on board, hold value rather than growth. And I'll leave that aside for the moment and focus on the underpinnings, specifically largely the political underpinning, which obviously is very important to investors, because if you have a political vacuum, then you don't know what you end up owning and what it's worth. So with that top of mind, let me try to stitch some things together. But before I go there, let me just preface the political remarks by stating the obvious. We are facing, mostly globally, unprecedented, at least since World War II or modern time, unprecedented political, financial, and economic challenges, which are juxtaposed, ironically, against bubble valuations in stocks, especially in the US, and in bonds, especially in Europe and Japan. We globally have some $7 trillion of bonds that have a negative yield. Hello, Frankenstein finance. Hello, policy that favors debtors and pummels creditors, or property right protections, as determined by central bank policies, as attested to by some $16 trillion global central bank currency debasement, money printing, over the past decade. As regards U.S. equity valuations, consider the Standard & Poor's 500 trading at 25 times trailing GAAP, generally accepted accounting principle, EPS, and the Russell 2000 at 59 times trailing EPS. And by the way, on the S&P specifically, GAAP earnings, or EPS, are very important. Why? Because they don't ignore restructuring charges in recurring business lines, which analysts like to ignore and look at so-called operating earnings, while at the same time taking the lower equity that results from these charges to post a higher return on equity. Hypocritical or disingenuous, pick your poison. When expectations are high, let's stay with the big cap universe, the S&P 500 at 25 times trailing EPS, and PEs are higher still, that is beyond EPS growth assumptions, capital loss vulnerability is obviously very substantial. This is especially true if EPS guidance starts to come under pressure. And more details on this in a follow-up video. But speaking of EPS guidance starting to weaken, take a look at this chart, if you would, that I'm going to try to hold up here. And I must admit, I'm still not terribly good at this, all right? This headline here is the percent of S&P 500 companies issuing negative earnings guidance. There I go. And we go from Q1 18, you see this bar jumps up from Q2 18, really jumps up to above 75%, from about 50% in Q1 to 75% in Q3. So we have EPS estimates or guidance coming under pressure, and this is prior to a full-blown recession or a financial incident. So, but let me get back to the main point, and that's politics. I wanted to frame this with very vulnerable equity valuations and some current information for people to work with when they take a look at their equity allocations in the US and by extension through much of the world where there are pockets of overvalued stock markets left, especially in the OECD part of the world, as the post goes into the link. I often refer, you might be even tired of hearing it, but I think it's so important, about an increasingly eviscerated rule of law. The enfeebled Constitution, if you will, and the disappearing representative government in the US where unelected bureaucrats rule unconstitutionally. They make legislation, they pass the laws, not the legislative body, the Congress, or in Europe, the parliaments. They've been pushed aside. This is something that, as you can gather, is not only happening in the US, but globally. So we have unelected bureaucrats running the show, and representation goes wanting. In addition, and concomitantly, in place of free market capitalism, property right protections that are robust, price discovery, the free market figures out what assets are worth, not central bankers, balanced budgets, productivity, sound money, and freedom of speech. All these policies are actually tied at the hip, and they are the polar opposite of what we've had on offer and continue to have on offer, namely K Street and Wall Street crowing capitalism, redistributionism, massive third world amnesty in OECD countries, financial repression, ZERP, NERP, and QE, declining productivity, growing deficits and debts, PC or political correctness, and vaulting higher intimidation, and unsound money. These are also all tied at the hip. In my mind, it's literally a battle of good versus evil, of freedom and societal wealth versus despotism and broad-based impoverishment. Translation: we live in a world where the select few live and profit and have power like never before, the fraction of a 1% or the 1%ers, at least not since the age of kings and queens. And this has been at the expense of the many disenfranchised citizens / voters. I call it Main Street. In short, an OECD world in which private property rights and freedom, they're also tied at the hip, are being trampled by what I refer to as a toxic public policy stew, in which cronyism trumps the free market. We're referring to green cronyism. For nice, juicy detail, take a look, if you would, at post 21 on CO2 demagoguery. From green cronyism, further limiting the very dense and affordable energy that we need to have leveraged output, to have earnings per share, or dividends, or be able to pay interest. That's all dependent upon leveraged output, all right? And it also affords or enables dense energy, 24/7, affordable energy, productivity gains, which are the only wealth of nations recipe for the most people, right? So we have a world where Wall Street and K Street bailouts that have been of utterly inconceivable magnitude, that have enriched the C-suite, that has so failed while lining lobbyists' pockets. Case 3. In the coming round, 2008 on steroids, Main Street faces bail-in and digital currency property misappropriation risks. In vernacular, more property theft, more bad politics. A world in which takers trump, no pun intended, Main Street makers. Redistributionism over work, value-added, achievement based upon the market ferreting out the winners and the losers, and interest that's actually earned on hard-won savings. For contrast, think of zero interest rate policies or the ultimate Frankenstein finance, negative interest rate policies. A world in which Main Street makers face untenable, at least in the US and increasingly elsewhere, healthcare outlays, while subsidized takers and illegal aliens have everything for free. As a personal note, I grew up with a man that was a medical doctor, is a medical doctor in Naples. I've known him since I'm 8 or 9 years of age. We grew up in upstate New York, a leafy hamlet by the name of Niskayuna, New York. Half of the babies that he has delivered in his career down here in Southwest Florida, the Naples area, have been for free. And the vast majority of those have been on behalf of deliveries on behalf of Spanish-speaking women of Latin American extraction. We have a world in which massive third world amnesty transfers property rights / savings from citizens to non-citizens while paying a wave, encouraging a wave of immigrants from alien cultures to, in effect, balkanize instead of assimilate and mainstream into their host countries. I see it weekly in Lee County's public schools, by the way. Enough insanity and national suicide by OECD nations, wouldn't you agree? But wait, it gets worse. You've all seen the Kavanaugh confirmation / nomination circus for the vacancy on the U.S. Supreme Court. If the leftist mob's hit job succeeds or simply leaves an indelible impression of what awaits future so-called originalist appointees, those that try to interpret the Constitution, how can we hope for a future rule of law if constitutionalist appointees to the highest court in the land are effectively shut down or totally discouraged or intimidated, and due process rights, Bill of Rights, are effectively stripped of relevance in the process? Something Trump's recent footshot remarks that he could change his mind about Kavanaugh aren't helping at all. This new poisonous case precedent, if Judge Kavanaugh is sent packing, will inevitably trickle down to all kinds of other appointments, as well as to those running for office that don't agree with a regressive, despotic, intolerant, freedom of speech muzzling agenda of the left. In other words, if future originalist Supreme Court picks have a fear of a, quote, borking, unquote, a Clarence Thomas pulverization and or a Kavanaugh character assassination, what does this say about bringing future judges with constitutional fidelity on to the bench? Moreover, What does it say about returning to a more robust rule of law as determined by Supreme Court decisions? And what does it say about tyranny by the few or mobocracy by the many that a constitutional republic featuring inalienable rights is supposed to prevent? Inalienable rights that no politician can take from you. Inalienable rights that are not up for a vote or up for discussion because your neighbors or there's a mob doesn't like what you have or wants what you have or wants to shut down your freedom of speech. Why? Because they are God-given, natural rights for all humans, no matter where they live. They also happen to be the recipe not only for freedom, but for a flowering economy. In post 47, I summarize it in these terms in a financial and political sense. With 21 trillion in unaccounted for U.S. government spending, pointing to an additional 21 trillion in unaccounted for money. What does that mean if there's twice as much of something as you think? What happens to the price? What happens to the value of the dollar? By the way, that 21 trillion is more than the entire US GDP. With widespread lawlessness at the highest echelons of power, with an ongoing coup attempt to remove a duly elected president from office or to totally incapacitate him, and with an increasingly encompassing effort to institute de facto one-party government, which is nothing other than tyranny by the allegedly, quote, out of power, unquote, Democrats, as enabled all too often by statist rhinos, Republicans in name only, as currently on display with the Kavanaugh confirmation circus. Confidence is not being furthered and trust in the rule of law being reinstilled. All said, such goings-on threaten a return to a reinvigorated constitutional order, which is in deep, deep trouble in America and throughout the West. And for the same political reasons, our bubble valuations, which are already disconnected from financial and economic sanity, are also in deep trouble. Why? Because investors assume stout or relatively stout rule of law protections, including the all-important property right arena, which has long been under attack by the courts and the bureaucracy. For details, check out post 47 and the links. This is something that is occurring domestically as well as in other OECD nations. For flavor, CO2 tax insanity, rising user fees, progressive taxation, transfers of property from citizens to non-citizens, and so on and so forth. These are in aggregate very corrosive of economic vigor and, frankly, of freedom and property rights, which are, once again, to use that term, tied at the hip. At some point, likely all of a sudden, trust will wilt, and asset prices will catch up with political, financial, and economic reality. Perhaps Trump's recent, yet overdue, declassification of key FISA documents will prove to be the catalyst that pulverizes confidence by disclosing the unparalleled bureaucratic, i.e. deep state, lawlessness that has been taking place, but only if the declassification is actually released for public view. All this begs a question. How can one value assets in a de facto banana republic? And this from a host of perspectives, including numerous top-tier, unindicted felons on or previously on the taxpayer payroll that are still at large, that still roam free. How can one value assets in a de facto banana republic versus in a constitutional republic other than with extreme caution? That is, by demanding high bond yields or passing and purchasing only low PE stocks or none, which is the antithesis, the complete antithesis of today's U.S. asset valuation bubbles in bonds and stocks. I think bonds today remain in a bubble, even with the 10-year having pierced 3%. For more flavor on where they've gone in troubled times in the past, check out post 47. Let me point to 15.2% as an indication on the government bond side. And by the way, government bonds and private sector corporate bonds, a lot of them, most of them, are in effect junk bonds without any yields or without any protection against insolvency or inflation. And those two also travel together, as we'll get to in a later post, and we've already covered. So the question here is, how long will the bond vigilantes, the algos, and the so-called market technicians remain asleep at the switch? Will the spreading emerging market contagion or an expanding trade war be the trigger that flips that switch? Or will we have to await a U.S. equity market swoon before the Fed's unprecedented QT morphs into unprecedented QE? This, ladies and gentlemen, is the $64,000 question, especially given the Fed's QT in nearly full-blown mode, specifically $50 billion per month or $600 billion per annum of asset sales amidst, get this, huge and growing debt, rising deficits, and crumbling emerging market currencies that are indebted in US dollar terms. And by the way, crumbling emerging market economies are no longer able to hitch a ride on the erstwhile speeding China growth train, as that nation's economic locomotive role has run into a $34 trillion wall of debt, a tally that has led to a 266% Chinese debt to Chinese GDP ratio as of the close of 17, up explosively from 162% in 08. So the question remains, how long until the U.S. stock market succumbs to political, financial, and economic valuation reality 101 and to an increasingly dicey global economy? And will the U.S. stock market again lead or ultimately lead the U.S. bond market into a full-blown bust, just as happened in the 70s? That too is looked at more closely via link an excellent chart from Yardini.com that displays that. Let me close with an unindicted felon example to drive home the point how politically dicey things are, lest you accuse me of massive claims inflation. I think this one example nails it and tells us about the magnitude of lawlessness that we are facing by the very people that control or have controlled the instrumentalities of power. For absolutely outrageous, over-the-top flavor, consider Hillary Clinton. The erstwhile presidential candidate and felonious former Secretary of State destroyed massive amounts of evidence while gravely violating classified information security protocols with her private servers, and thus gravely threatened national security. Yet, she was effectively exonerated by former FBI head Comey, who had the temerity to A, usurp judicial power, and B, at the 14-minute mark of a self-righteous July 5th, 2016 tirade on this matter, warned that everyday Americans, in contrast, would be held accountable for such behavior that Hillary Clinton engaged in. Quote, "This is not to suggest that in similar circumstances, a person who engaged in this activity would face no consequences." Ding, 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 ding. When there are two sets of laws, one for the mighty who stand above the law, another for the rest of us who have to abide by the law, a society by definition cannot have the rule of law. We hope you find this of interest and use amidst our asset bubble landscape, specifically in the US and elsewhere to a declining or decreasing extent. Thanks a lot for tuning in. If you're so inclined, please spread the word. The more hits we have, the better our chances of sustainability.